Most Americans believe investing is the path to wealth. You invest in the stock market, wait long enough, and eventually you win. That's the story we've all been told. But here's the uncomfortable truth. Most Americans actually lose money investing. Not because they're stupid, not because they're lazy, but because the system, the psychology, and the advice they're given quietly work against them. In this video, we're going to break down exactly why so many people invest for years and still end up disappointed, stressed, and behindhand. More importantly, how to avoid the same mistakes. The big lie about investing. The biggest lie about investing is that it's just about picking the right stocks. Schools don't teach investing. Most parents can't explain it. And financial media turns it into entertainment hot tips, breaking news, and overnight success stories. What nobody tells you is that investing is less about intelligence and more about behavior. The average American investor doesn't fail because of math. They fail because they're human, emotional, impatient, and constantly reacting to noise. Mistake number 1, starting too late. One of the biggest reasons Americans lose money investing is that they start too late. Many people wait until their 30s, 40s, or even 50s to invest seriously. Not because they didn't want to, but because life got expensive. Student loans, rent, credit cards, kids. By the time investing becomes a priority, time is already working against them. Compounding rewards patience, but it punishes delay. When people start late, they feel pressure to catch up, which leads directly to the next mistake. Mistake number 2, chasing returns. When Americans finally start investing, they want fast results. They chase whatever is performing well right now: hot stocks, trendy ETFs, crypto booms, meme stocks. They buy after prices have already gone up, driven by headlines and social media hype. This isn't investing, it's performance chasing. And historically, it's one of the fastest ways to lose money. Markets reward discipline, not excitement. But excitement is what gets clicks, views, and attentions, so that's what people follow. Mistake number 3, selling during panic. Here's a brutal reality. Most investors don't lose money when markets crash. They lose money when they sell. When the market drops, fear takes over. News headlines scream recession. Portfolios turn red, and suddenly, logic disappears. People sell to stop the bleeding. They lock in losses. Then when the market eventually recovers, they're too scared to get back in. This buy high, sell low behavior is incredibly common, and it destroys long-term returns. Mistake number 4, overtrading and overconfidence. Many Americans believe being active means being smart. They check their accounts daily, they trade frequently, they react to every dip and rally. But studies consistently show that the more people trade, the worse their results. Overconfidence is expensive. Every trade comes with friction taxes, fees, timing mistakes. Long-term wealth is built through patience, not constant action. But patience doesn't feel productive, so people do too much and pay the price. Mistake number 5, ignoring fees and taxes. Fees are silent killers. A 1 or 2% fee doesn't sound like much, but over decades, it can cost hundreds of thousands of dollars. Many Americans don't understand expense ratios, management fees, or tax inefficiency. They focus on returns instead of what they keep. Wall Street doesn't need to beat you. They just need to stay between you and your money. And for many investors, they do. Mistake number 6, nitrogen monoxide. Clear plan. Most Americans invest without a real plan. No clear goals, no timeline. No risk strategy. They invest because they know they're supposed to. But without a plan, every market move feels personal. A solid investment plan tells you what to do before emotions take over. Without it, every downturn feels like a crisis and every rally feels like a reason to gamble more. The psychology that destroys returns. Human brains are wired for survival, not investing. Fear and greed are powerful forces. Losses hurt more than gains feel good, and social comparison makes everything worse. When friends brag about gains, people feel behind. When markets crash, fear spreads faster than logic. Investing success isn't about beating the market, it's about not beating yourself. Why simple strategies beat most people. Here's the irony. The strategies that work best are boring. Long-term investing, broad diversification, low fees, consistent contributions, doing nothing during market chaos. These strategies don't make headlines, but they quietly outperform most investors over time. The biggest advantage you can have isn't secret information, it's discipline. Final message: how to stop losing. If you're investing right now and feeling frustrated, here's the truth. You're not broken. The game is designed to tempt you into mistakes. But once you understand the traps, you can avoid them. Start early, stay consistent, ignore noise, control emotions. Investing isn't about getting rich fast, it's about not getting poor slowly. If this video helped you understand investing better, hit the like button, helps more than you think. Subscribe for honest personal finance content. Comment below. What's the biggest investing mistake you've made or almost made?